it seems that various people have joined, so I will now start proceedings. We're delighted to welcome Chiara Scotti from the Board of Governors to speak to us today on a very important topic, a topic I know a few of us have done some work on, so hopefully we'll have some discussion and Q&A. Chiara's been at the board for some time now and has a decorated career within the board as a policymaker and also researcher, perhaps known in particular for some of her well-cited and widely used indices about business conditions and uncertainty. Her work has spanned now not just the macroeconomics, monetary policy, but over towards financial stability. So a great fit with our with the topics that the Qatar Central Bank and QCGBF are particularly interested in. So we're really delighted to have you, Chiara. We're going to have questions throughout, but in the Q&A, people. So if people want to submit questions, I'll sort of then introduce them as and when, or perhaps defer them to the Q&A at the end. So we're going to have about 50 minutes of talk and then 10 minutes of explicit Q&A. So take it away, Chiara.
Well, thank you for the kind introduction and thank you for inviting me here today. I will be presenting a paper titled Interconnectedness in the Corporate Bond Market. This is joint work with three colleagues from the Fed, Celso, Chehi, and Jacob, and also with Matt, who's currently, who used to work at the Fed. He used to be a research assistant at the Fed, and now he's a PhD student. Because I work at the Fed, of course, I have to start with the usual disclaimer that the views expressed in this presentation are those of the authors and are not necessarily those of the Federal Reserve System. Before I turn to the introduction, let me just say that this is a paper about interconnectedness, about network, but it's also about much more. It's about financial stability, it's about big data, it's about asset pricing. So I really hope that you all will find something of interest in the paper. And it's a work in progress. So we really appreciate any comments that you might have as we are, literally still working, doing estimation and writing up the paper. So there is, the academic literature does not provide a definite answers on whether interconnectedness is good or bad for financial stability. A seminal paper by Allen and Gale in 2000 argued that interconnectedness is associated with improved financial stability. And in particular, they showed that a more complete network provides better risk diversification opportunities, and therefore it limits contagion compared to an incomplete network. However, recent economic research challenged this argument. And so current discussions on interconnectedness focus on the trade-offs between more benefits that come from direct links versus greater exposures to the risk of default through increased number of linkages. And so this tension then generates a bit what is known as robust yet fragile. That is, the very features that make the system stronger under certain conditions may be a source of instability under another. And Acemoglu et al. In their 2013 paper showed that when the magnitude of negative financial shocks are small, a more complete network is actually prone to systemic failures because the losses are absorbed by a large number of counterparties. But when the shocks are larger, then incomplete networks emerge as more stable than complete networks because, in a way, they hold contagion. And so, in recent research, there has been like many other papers that try to identify what improves and weakens financial stability, and it's exactly against this backdrop that we explore the role of interconnectedness in corporate bond markets. We develop a novel measure of asset-based interconnectedness at the QCGBF level instead of the firm level, and I will explain better what we mean by that, of course, in the rest of the presentation. We dig into a gigantic data set, which is the eMAXX data set, and link it to other data sets. And in this sense, our paper, is about big data because we're really using very big data sets. We contribute to the understanding of the role of interconnectedness on corporate bond markets functioning and its impact on financial stability. And in particular, we show the importance of interconnectedness for corporate bond pricing. And so, in particular, we connect to the asset price literature, especially with regards to the emerging studies on institutional asset pricing and institutional price pressure. And so far, for example, the literature has shown that the risk-bearing capacity of intermediaries matters for asset prices and for risk premiums. It has shown that capital risk factors of intermediaries explain returns, or also that institutional investors have temporary but sizable impact on equity prices via fire sales. And so again, we instead highlight the importance of interconnectedness. Just to give you a little bit of overview of our results, we show that interconnectedness is related to the spread, to the liquidity, to the volatility of corporate bonds. We show that higher interconnectedness is linked on average to lower spreads, higher liquidity, and lower volatility. And we also show that the impact is more pronounced at the right tail of the conditional distribution of spread, illiquidity, and volatility. And so here is, when we dig into a little bit of the financial stability questions. In the rest of the presentation, I will follow this plan. I will first tell you a little bit about our interconnectedness measures. I will give you an idea of the regression setup that we use. Then I will go through the data and show you summary statistics for the data. I will show you the empirical analysis, our results, and then I will tell you where we are headed with our future work, and I will then conclude. So let me start by talking about interconnectedness measures. So networks in finance have been mapped generally using three main techniques. The first one is correlation networks, and Billio, Getman et al. 2012 or Diebold and Yilmaz 2014 are examples of the correlation networks. Those are networks in which the edges among financial institutions are based on the estimate of the variance-covariance matrix of publicly available data, such as asset returns. And so in other words, these are networks where the edges, the connection between two nodes, are based on correlations or a function of correlation. Then the second group of networks is, or second group of papers is that analyzes, that focuses on physical networks. And the Brunetti et al. 2019 paper is an example. And in these networks, the edges capture contractual agreements among counterparties, such as, for example, interbank transactions. And so, as I said, the physical network captures risks that stem, for example, from contractual agreements like CDS. And then finally, a third group of a third technique is that looks at common holdings of networks. And Caccioli et al. Papers and Greenwood paper 2015 are examples of these other techniques. So the idea of the common holding networks is that firms are connected if they hold similar portfolios. And so assume that you have Bank A and Bank B in the network and they have the same portfolio. Assume that Bank A is hit by a shock and has to sell its portfolio, then the value of Bank B's portfolio will also be affected. And so this in a way represents the theoretical justification for the correlation network of number one. In this paper, we propose a new approach for mapping financial networks, which mirrors the notion of overlapping or common holding networks, so mirrors the number three above, but it is based on the assets. So it is an asset-based network, and we call it overlapping investors or investor similarity network. The starting point for both network structures, so either the conventional approach that I'm showing you in these slides, and then I will show you our approach in the other slides, is a bipartite network with two sets of nodes, the firms and the financial assets. And so the idea is that, as it is shown in this figure, if a financial institution holds an asset in a portfolio, then there is an edge between the financial institution and the particular asset. And so, for example, because firm one holds asset A and asset 3, there are edges between this firm and assets A, 1 and 3. And so the traditional network implies that since asset 1 is also held by F2 and F3, then all three firms are interconnected. And this is what you see in the bottom part of the figure. So firm 1 is linked to firm 2, but is also linked to firm 3 because of the common holding asset 1. And then also firm 2 and firm 3 are linked because they hold asset 1 and 2. So an alternative way to look at this is what we're doing in this paper. And so, in a way, it's very similar in that, we are exactly replicating what you saw in the previous slide. But as you notice, we are reversing the arrows because at this point, our focus is actually on the assets. And so the network of investor similarity is based on the idea that two assets are interconnected if they're held by the same firm. And so, for example, A1 is linked to A3 because these assets are held in the same portfolio of firm 1. And similarly, A1, asset 1, is linked to asset 2 because these assets are are held by firm 2 and firm 3. And so just to give you a little bit of idea of this justification of why we're using this, I think that the current situation with the Russian crisis, with the Russian-Ukraine crisis, is a good example in that if Russian bonds are held by certain firms together with non-Russian bonds, then there is a link between the Russian and the non-Russian bonds through the firms that are holding these bonds. And the idea is that if Russian bonds cannot be sold, then there is a contagion effect that transmits to the other bonds. There are no Russian bonds that might need to be sold if, for example, the first need liquidity or need to cover some losses associated with the Russian bonds. So let me get into a little bit of notation here. So we consider a network of financial assets. We have S of those, these are the A's, and firms, so we have N on those, and these are the F's. We show in this matrix E, basically the dollar amount invested by each firm into an asset. So E11 would be the amount of asset A1 that is held by firm F1. And, of course, the same for everyone else. If we sum across the columns, we get this V1A, which is the total amount of asset I held by the system. And just for all of you that are used to, the more traditional network structure, in that structure, basically you would sum across the rows rather than sum across the columns. And so these values, VIA, the total amount of assets, the total amount of a certain asset that is held by the system, is the so-called network strength. We can define then the adjacency matrix, eCircle, which is simply the same as the matrix below, where each cell, instead of being the total amount of asset held by a firm, is actually sort of a dummy equal to 1 if the firm holds a positive amount of that asset and 0 otherwise. And again, if we sum across all the columns, we get the number of firms that hold a positive value of asset I. So we get the number of firms investing in that asset. And this is called as called degree of the asset I. From the network of financial assets and institutions that I've just shown you, we can then derive the network of investor similarity, which capture the interconnectedness among assets as a function of belonging to the same portfolio. And in particular, we can derive two measures which of interconnectedness, which we call the overlapping investor measure and cosine similarity. The overlapping, these are two measures that we will then use in the remainder of the analysis, and the overlapping investor measure is based on PIJ or PA1, which is basically the inner product of eCircle and counts the number of portfolios two assets are part of. And the cosine similarity is based on PA2, and it captures the distance between two non-zero vectors of an inner product space, and it is divided by the norm of the degree of the network, dA, which represents the vectors of firms holding asset I and J. They're both rescaled by n times s minus 1. It will become a little bit clearer later why, but basically, both n and s, they are time varying our sample. N, recall, is the number of firms in our sample, and S is the number of assets. Overlapping investors and cosine similarities are similar or broadly measures the same thing, but however, they can be different in certain situations, and it's not that one is always better than the other, and therefore we decided to use them both in our analysis. So let me give you an example so that I can hopefully fix ideas, in your mind. So we're just totally coming up with numbers, totally fake numbers, and also totally fake that we have, exactly the same number of firms and assets. It's just, a simple thing that we could do. But the idea is that we have our eMAXX, where the numbers 6, 5, and 4, for example, indicate that firm 1 has 6 units of assets A1, firm 2 has 5 units, firm 3 has 4 units. We can construct our eCircle, which is the adjacency matrix. And again, recall that this is basically similar to E, except that it is just every cell is equal to 1 if there is a non-zero amount in the matrix E. And so, in this case, the first row would always be equal to 1. The second row would be 0, 1, 1, because firm 1 doesn't have any investment in asset 2. We can then sum across the columns, and so we can get the strength summing across the columns of matrix E, 15, 5, and 1, and then we can compute the degree of the network summing across the columns of the eCircle, 3 to 1. We can then compute our PA1 and PA2 matrices. And again, we get that for PA1, we get a 2 for the matrix of assets A1 and A2, intersection A1 and A2, because A1 and A2 are held by two firms. A3 and A1 you get a 1 because they are only in the portfolio of one common firm. You can do the cosine similarity, and you get slightly different numbers because the formula is different, and there is scaling. But in any case, these numbers represent the edges and capture the strength of the connection between the different assets. And using the formulas above, basically we can compute our overlapping investor and cosine similarity measures. They offer very similar intuition, very similar results in this setup. And basically, we get that asset 1 is held by all 3 firms, and in fact, it has the highest interconnectedness compared to the other 2. And asset 3 has the lowest interconnectedness because it's only held by one firm.
Chiara, may I ask a quick
Yes.
question? It's one of mine, actually. So is there a sense in which this is sort of like a first order, first level connection? Is there, or does it capture sort of, I'm just sort of thinking about iterating these connection matrices to say how far away they are, or is it just taking into account the immediate cross holdings in some sense of the?
So in a way, the overlapping investor, it is sort of only taking into account, I don't know exactly what you mean, because I guess when you talked, 2 things came to mind. One is the distance, and the other one is, the repetition of computing this measure.
I guess I had in mind chains of the firms holding the assets rather than whether or not this relies on just so carry on with your answer.
So, if chains, you mean whether we track it across time? We do.
Yeah.
So
okay.
Basically, at every point in time, we compute these measures, and this measure is specific to a certain asset, and it changes through time because, of course, the portfolio holdings changes through time. Okay. And in addition, I guess that from what you were saying, you were also talking about, distance. And these measures are basically capturing both whether they are part of the same portfolio, but also in a way, how distant the one asset is compared to another based on the different portfolios that they're part of.
Okay, cool.
So I hope I understood your question, and I hope I answered it.
I didn't very well. Okay,
but we can talk a little bit more later. So let me tell you a little bit about our regression models that we have in mind. So of course, we always start by computing the mean effect, but we're really interested also in looking at quantile effects. So in terms of the mean effect, what we have in mind, we want to understand the relationship between interconnectedness and some measures of corporate bond market functioning like spread, illiquidity, and volatility. And so to do so, we have a panel regression where we link spread IT or illiquidity IT, volatility IT, meaning the volatility of a certain asset at a certain point in time. We link it to the interconnectedness measures that we have. And we do this by controlling for, X, a matrix X, which is a matrix of time-varying bond characteristics, which includes trading volume, outstanding issuance size, coupon rate, credit rating, and time to maturity. But we also control for an issuer fixed effect and a time fixed effect. However, averages is not always what we want to look at. And I guess for those of you who are used to thinking about financial stability issues, we're really interested in understanding a little bit better what happens when things don't go well, when we are in the tail of the distribution. And so this is why we'll also look at quantile effects. because we're actually interested in estimating the conditional quantiles, so spread, liquidity, volatility, and understand how those are linked to our interconnectedness measure. And, I will show you results of all of this later. But before going into that, let me tell you a little bit about our eMAXX data set and also about the trace data set. We use some additional data sets, like, for example, the FISD data set, but just to collect some additional information. And so I'm not going to go into the details for that. Let me start from the eMAXX database. So this is a very big database that offers a comprehensive view of institutional holdings of corporate bonds and other fixed income securities. It is at the individual institutional investor sub-account bond year quarter level. So it's information that is very, very specific about what bond, in what year, in which quarter is held in which sub-account of which investor. It starts in 1998 Q3, and the latest one available so far is 2021 Q3, but we've been updating on a regular basis when new information becomes available. We focus on US domiciled funds, and in our analysis, we focus on corporate bonds only. So how do we make our data set useful for us? First of all, we identify institutional investors. And so the idea is that in the data set, we have really very granular information. And so, for example, for a mutual fund, we have information about, or let me use a better notation, a better dictionary here. If we're looking at an investment manager, we have information about all the funds that are part of that investment manager, that belongs to that investment manager. And so we're interested in identifying sort of the parent of the investment manager, the parent of the bank. And so this is why we go through this all of these steps that I will describe in this slide. And so first of all, we use a string matching algorithm to match investors that belong to the same company. We conduct a manual audit on the matches to ensure validity, so that we obtain a dictionary to map each subsidiary into its parent. And we categorize each investor as either a bank, an investment manager, an insurance company, or other investor types. And then we aggregate the corporate bond holdings to the institutional investor level, so at this parent level. We only select the largest institutional investors. Again, it's a very computationally intensive exercise. Imagine that when we compute the our measures of interconnectedness, we're really like computing going pairwise, looking at all the different assets, all the different portfolios. So it's quite intensive. So we decided to only look at a subset of institutional investors. We select the biggest ones by looking at the asset under management and checking that it is within the top 50th percentile of the AUM distribution each quarter. And to give you an idea, this gives us with leaves us with 198 banks, over 700 investment managers, over 600 insurance companies, and over 200 other funds. And also is a subset that holds about 80% of the total par amount of corporate bonds that are held within the eMAXX universe. So, even by doing this, we are really selecting a big chunk of the universe. And then we also subset based on degree. And so, we are interested in interconnectedness. And so in some sense, if there are bonds that are really held by very few institutional investors, we really don't care too much about those. And so we select corporate bonds that are held by at least 10 institutional investors on average during the panel. We use additional information from eMAXX like QZIP, and we can use either the QZIP at the 6-digit level or the 8-digit level. The 6-digit level is basically at the issuer level. 8 digits is giving us information about each single bond that is issued. And so the example is, in this case, 6-digit, we're interested in IBM corporate bonds, IBM issued corporate bonds, versus 8-digit, all the different corporate bonds that are issued by IBM. In this presentation, I'm showing you the analysis for 6 digits, but clearly, everything could be done also at the 8-digit level, but things become even more sparse because you would be looking at the specific bond. Then in addition to QZIP, we look at, we use the ratings, maturity, and coupon rates from eMAXX. We also use another data set, which is the trace data set, which is another big data set with security level data on transactions of corporate bonds. And from this, we compute spread, liquidity, volatility, and trading volume measures. So the spread is measured as the difference between the average yield of all trades on the bond on a day and the comparable treasury. Illiquidity, we look at 2 different measures of illiquidity. The yield price impact, which is defined as the sum over the total number of trades of bond I at time t of the ratio of returns and traded volume. Or we look also at the interquartile range, which is simply the difference between the 75th and the 25th percentile of daily prices. And then we compute realized volatility as the quarterly standard deviation of traded prices of a bond. So we then aggregate the intraday trace data at the quarterly frequency to be able to match it with the quarterly level eMAXX data. And because trace frequencies may be sparse for some bonds, we check robustness in our analysis by computing different ways, alternative ways of these measures. So for example, we look at the mean, the median, and the last quarterly observation of the variable. And this is what I show you in this slide. When you see spread, we look at the mean, median, and last observation, the same for trading volume, illiquidity, the 2 measures of illiquidity. But let me talk a little bit about some basic statistics on the issuer level bond characteristics. The averages are in line with what the previous literature has found. But some important things here are that even after we Winsorize at the top and bottom 1%, there is still great heterogeneity across bonds and across time. And so, for instance, we see that most means are larger than the medians, as, for example, can be seen from the spread, from the trading volume, illiquidity, and so on. And this means that within a quarter, there is a great dispersion in terms of days when certain bonds are traded more often and thus become more illiquid. There is a wide spectrum of situations, for bonds, and this is shown also by looking at the mean and the max. The max is usually, way larger than the mean, meaning that there are certain bonds on certain days that are traded much more than, other bonds. And again, this is in line with what has been found in the previous literature, in that, the previous literature has found that most corporate bonds are illiquid, and the relatively subset of bonds are traded, more often. A little bit about rating, because as you know, ratings is normally, expressed in letters. So we translate that into a 21 scale, where 1 is the minimum rating, 21 is the maximum rating. And so when we say that the minimum rating is 5, this corresponds to a CCC plus, for example. When we say that the max is 21, it means that this is the highest possible, a AAA. The mean corresponds to a BBB minus. The mean of 12 corresponds to a BBB minus. A little bit of basic statistics for bond holdings data. So we are currently not exploiting this in our results, but we can track information for the different institutional investors. At the moment, we just put them all together. But in this slide, you can see that we have, the number of unique investors across time for banks, investment managers, insurance companies, and others. And so, for example, you see that the number, increases for investment managers and decreases for banks. And you can also see the number of unique corporate bonds across time. And so this raises a little bit the issue of, is it because our institutional investors are on average holding more bonds, or is it driven by just, greater issuance of corporate bonds? And so I think we answer a little bit this question looking at these slides, in which we show the holdings as a share of the total outstanding amounts. And you still see that, you have this, this trend that there is an increase in bond holdings by investment managers, and a decrease, for example, by insurance companies. Again, just for sake of completeness, these are the measures that we computed from the trace database. You see that there are some clear patterns, some with spikes during the great financial crisis, but then there is also, the beginning of COVID, March 2020, or Q1 2020. But let me tell you a little bit about summary statistics of our interconnectedness measures. So we have more than 7,000 observations, meaning that there are more than 7,000 issuers that we follow through time. The mean of the number of quarters is 18. This means that an issuer is on average in 18 quarters in the sample, with a minimum of 2 quarters and a maximum of like 18 years, so almost the entire data set. Strength is the total amount of the assets of a specific issuer that are held by the system, and these are clearly big numbers, as you can see. The degree means that on average an asset is in 44 portfolios, though there is very high variability. And then the cosine similarity and the overlapping investors are the two measures that measure the difference between how two assets are held across firms. And there is also, quite a bit of variation for these numbers, but these are the numbers that we will be using in our analysis. So let me go to talk about our results finally. So this first table shows the panel regression of spreads on our interconnectedness measures, plus the different control variables that we use, including the fixed effect. We have quite a big number of observations, over 130,000 observations, and we have very good R-square, almost 0.8. The good news is that both the overlapping investor and the cosine similarity are significant, and they have a negative impact on the spread, meaning that an increase in interconnectedness decreases corporate bond spreads. And if we interpret the spread as a measure of risk appetite, this means that an increase in interconnectedness increases the appetite for these bonds. All the variables in this regression for ease of exposition are standardized, so that a one standard deviation increase in the overlapping investor measures lower the spread by 33 basis points. And I'm not going to flip back to the slides, but just trust me on this. This corresponds to about 1/10 of the standard deviation that we showed on the previous slides. Cosine similarity shows a very similar magnitude, and these magnitudes are actually quite in line with what we see for the other variables, because also for example, the coupon rates, the outstanding issue amount, or the trading volume, you have very similar magnitudes. Second table of results is very similar to before, but we're now looking at illiquidity and interconnectedness. Again, looking at illiquidity, both measures of interconnectedness are significant and have a negative sign, meaning that an increase in interconnectedness decreases corporate bond market illiquidity or increases liquidity. So an increase in interconnectedness, again, is a positive thing. Both the right-hand side and left-hand side are again expressed in standard deviation. They're standardized, and in this case, a one standard deviation increase in the overlapping investor measure is associated with a 0.05 standard deviation increase in the Hamiud measure of liquidity, and 0.06 for the cosine similarity. The magnitudes in this case are a little bit smaller than, for example, coupon rates, time to maturity, and trading volume, but they are in line with some of the others, like the the rating. Again, we have fixed effects, big number of observations, and very good R-square. Turning to realized volatility, both measures of interconnectedness are still significant. They have a negative sign, meaning that an increase in interconnectedness on average decreases volatility. So interconnectedness is again a good thing. Results like before are the variable as before, they're standardized, and so we get the one standard deviation increase in the overlapping investor measure is associated with a decrease of 0.06 standard deviation of realized volatility. So as I already mentioned, looking at averages is interesting, but within a financial stability framework, we're actually interested in knowing what happens when things are out of whack at the tails of the distributions. And so in particular, in the case of our three variables, spreads, liquidity, and volatility, we're particularly interested in knowing what happens in the right tail that corresponds to stressful market situations when spread and volatility are high and liquidity is low. Meaning that, when we are in situations of, average spread, average volatility, and so on, things are sort of going smoothly. And so we might not be very interested in knowing, what is happening. But when we are in a very stressful situation, it's useful to know whether interconnectedness is good, whether interconnectedness should be promoted. And so these are the results, the preliminary results from our quantile regressions. You see results for overlapping investors on the first row. You see results for cosine similarity in the second row. And then you have spread, illiquidity, and realized volatility. I just decided to pack everything in one slide because they actually give the exact same message, which is when you look at the right tail of the distribution, the results is a lot stronger than when you look at the left tail. Right tail is the situation of stress in our framework for our variables. The left tail is, I wouldn't say normal situation, but like an easy functioning corporate bond market functioning situation. And so what you see is that you have this, I don't know if I call it a small downward trend, which is showing that an increase in interconnectedness during stressful market situations is actually very positive for corporate market functioning, as can be seen looking at the spread, illiquidity, and realized volatility. And when you look at situations of the left tail, so situation in which there is normal market functioning or easy market conditions, then interconnectedness is not as important for market liquidity. However, let me just say that, so far we basically studied a sort of correlation, like the relationship between interconnectedness and these other characteristics of corporate market functioning. But our next step is to try and study causation. And so we've been thinking about, different ways to do this. And we've been looking into isolating, we've been looking into events to isolate the effect of liquidity versus interconnectedness. And so, for example, looking at specific climate events, mergers of an asset managers, large outflows, or some other idiosyncratic events. If you have any idea, any suggestion for us, it's really welcome. We've been thinking about how to use and whether to use an IV setup, instrumental variable setup. In addition to causation, we're also thinking about studying the role of interconnectedness, looking at institutional investors by type, looking at subset of particular assets. So, given the granularity of our data, we can clearly do a lot. And this is what we have on deck, for the next few weeks. So let me just conclude. In this paper, which again is a work in progress, we develop a new measure of interconnectedness to study the relationship between interconnectedness and some corporate bond markets characteristics. We find that an increase in interconnectedness lowers spreads, liquidity, and volatility of corporate bonds, and that interconnectedness is particularly important during stressful times and for stressful bonds. And also, so far, our analysis is simply indicative of contemporaneous relationship. And so, you should stay tuned for the next results of this analysis. And this concludes my presentation. So I think that with 1 minute to spare, thank you very much for listening.
Thanks, Chiara. While people are getting their questions ready, just one question or comment. The quantile regression results very interesting. It seemed like the wide holding sort of protects against these really disruptive periods. I was just wondering if it might be worth including a sort of measure of complexity to adjust for whether or not certain assets are prone to fire sales. Because if you think of these sort of some of the slightly visioning ideas, that some assets might be a little bit more complex than others and need expert holders, and if the experts are constrained, then you might get some strange price movements. I just wonder if that might, if the fact that it's held by a lot of people, your sort of cross-holding measure of interconnectedness thing, whether it might just be picking up, this is a very standard asset. So the more cross-holdings you have, it's just that it's standard and less prone to needing an expert holder for it to hold its value in the market. I think that would be quite interesting. I think some people have looked at, I can't remember the people now, it's probably, I ask Antonio Filato, he knows this better than I do, but people have looked at very complex corporate structures and how certain bonds associated with companies with very complex corporate structures are more prone to needing expert holders. And once you need an expert holder, if the experts then are damaged, then you get the fire sale sort of loop beginning. So this might be something to include. So are there any other questions?
No, thank you. I mean, that is something that we should definitely explore. I mean, there are like a number of, as I mentioned at the beginning, we are sort of at the intersection of many different parts of the literature. And so we're really trying to bring together many things. And what you're looking at is really like the fire sale literature mixed with the asset pricing a little bit. Yes, I mean, I agree. We should look into that, but we haven't done so yet.
Yeah, there's a question that we've had in the Q&A asking about, well, suggesting that any assets that happen to be held by many institutional investors, they may be, they may be more liquid and less prone to shocks anyway. I guess it's a question of whether your controls are in there and it goes to your, but it asks also whether there's a way to differentiate assets held by just a few highly connected firms from those held by broad coalition of connected firms. And I guess I was going to ask about dealers and whether or not you distinguish whether or not some of these people holding them are sort of dealers as opposed to general market participants.
So I guess the second part of your question, we have not looked into those specific things. Is in the next part, as I was mentioning, looking at the different institutional investors and so on. But in terms of, I guess the first part of your question, I'm not 100% sure I understand.
Yeah, it's an endogeneity question. Are we just picking up, assets that are generally less prone and more liquid, and that's why they've been picked up by such a broad class of institutional investors? So it's a direction of causality question.
Yeah, and this is why we tell straight at the beginning, it's sort of a contemporaneous relationship, and we're going to try to do causation in the next stage. So we will definitely do that. Because clearly all these things are very related to each other.
Yes, there's a question. I've got another one through the chat. Do you have a sense of whether or not these firms hold, where there's a lot of broad holdings, do you have a sense of whether or not those firms are particularly prone to fire sales risks themselves, or do you want to introduce another dimension to your interconnectedness in some sense? Like, is it interconnected and held by very strong firms, or interconnected and held by, weak firms?
So that's interesting.
I guess it's adding another dimension to your measure, I suppose.
We haven't looked at that. We haven't thought about that. So what we can see is that, and you could see this from the summary statistics of our network. That the network is very sparse because clearly we are looking at very granular information, but there are certain bonds that are very common and certain bonds that are not common. So I think it might even be interested in looking at how results change, looking at exactly whether they're like more popular or less popular, but we haven't really looked into this kind of analysis yet.
I guess there's a little bit of tension here that says you require that there be at least 10 investors, and that sort of makes sense, I guess. But throughout this, I was thinking, well, this is relevant for fire sales, but it's often the less common, where you need more of an expert holder. Less common bonds where you might be more worried about fire sales. So by moving, if you're going to use this interconnectedness thing, and fire sales seems to be an interesting avenue, that restriction to just the very quite broadly held bonds to begin with might be something you want to relax and see what's going on. But I understand you've done it for sort of.
We've actually we've actually tried with different levels of this value, of the 10. Results still hold. It's just for the complexity of computing the measures that we decided to go with that. But I mean, yes, we were even thinking that we might even have a more stringent value, like 15 or 20, and results would not change dramatically, I expect. But yes, I guess one thing that is coming out with these questions is really a little bit thinking a lot more about fire sales, and we can think about that.
Like ultimately, there you're not necessarily looking for perhaps these marginal results you've got on the screen now about the security, but more about what does it mean for the related securities and things like that? Because at the moment, these results are sort of marginal rather than seeing how maybe some simple descriptives that bring in relationships among securities as opposed to any individual securities behavior would be quite useful.
Mm-hmm.
But I'll stay quiet now because we're going to meet anyway. So. Okay, well, unless there are other questions. There is another question actually. Yes. Excuse me, I'm just reading it. Well, it's sort of a mechanical question, really, about how you aggregated from the subsidiaries, which I think you meant with individual funds, up to the parent. Can you just reiterate how you did that, perhaps?
Yeah, I can bring you back. So we came up with a string matching algorithm to match investors that belong to the same company. And so let me say that, for example, Goldman Sachs or JP Morgan, they have something in the name that would allow you to basically match them with each other. So we came up with a matching algorithm so that we would go through and would pick up all the individual the individual investors, the sub accounts, and we would then bring them up and aggregate at the parent level. This is, I guess, our decision to do that. You could, maintain things at the more granular level, but and we could, we might explore that in the future. But I guess again, because the data is so big, we just decided that it made more sense to do it this way. And basically, again, we have this algorithm. We did a manual audit just to make sure that everything worked. And once we had basically the different investors that we were part of the same group, of the same parent, then we took all the holdings that corresponded to the particular investors and we aggregated them all under the parent. I hope this is clear.
Now that I've had time to read the question a little bit closer, I think the concern that's being raised, and it may not be anything you can do anything about, but the concern is that perhaps it's better thinking of these bonds being held by the clients of these funds in the background. So the connection may be, asserting that there's a connection between bonds through maybe these fund managers is perhaps not necessarily the correct way to do it. You might want to think about whether it's a connection between whoever they're putting these orders in for, perhaps. Is there any way around that maybe you'd want to think about the client connections between securities through the clients who are behind these?
So we don't have that information, but the idea is that it's the fund managers that decides on the portfolio position in the first place. And so, we just stay with that because we cannot really find information about the client. I mean, like even our data set, which is a great data set, doesn't have that information. So
yeah, indeed. Okay. Well, with that, I think, and we are actually at 3:00 now. So with that, we thank you very much, Chiara, for your presentation. Very interesting. It looks like it's already interesting work. It's probably going to be even better in the near future. Thanks very much. I will shortly meet you on Teams, and everybody else have an excellent week, and hope to see you in a couple of weeks' time for Andrea's Shrimp. Okay, best wishes.
Thank you, everyone.
Cheers then. Bye bye.